Hi folks, welcome to this video. Very interesting data is going to be presented here. This is about REITs versus real estate index instruments, the what and the why you should invest in REITs versus real estate index or real estate stocks versus the real estate. Uh, so that's the sort of three-pronged approach that we will keep for discussion. And let's dive in. So, for those who don't know what are REITs are basically financial instruments which are uh, representing companies or trusts which have income producing investments in, let's say, corporate offices, malls, etc. So, this is basically a financialized product where a trust comes and invests its investors' money into leases and those kind of income generating projects, and in lieu of that they float their stock and issue you units for that. So you can basically be a part owner of a real estate venture, so as to say. That is the whole purpose of REITs, and somebody else is managing the property. You are basically a part owner of a property which is getting managed by this manager in the middle. That is REITs. And the other part is real estate index, that is there, which is made up of real estate stocks in different proportions. And there are many instruments like ETFs, exchange traded funds, or mutual funds, or small cases that are focused on this real estate index or real estate stocks. And and this is sort of the second type of real estate investment that you could make. The third type, of course, is that you go directly and buy the physical entity. You buy land, you buy an office, you buy a house, you buy a mall, shop, or whatever it may be. So these are the three different opportunities that are available linked to the real estate world. REITs through other managers who will manage income generating properties, real estate index, ETFs or mutual funds, etc., which invest in real estate stocks or the real estate index. And third is the physical real estate. Now, a lot of folks remain confused between all these products. And let's dive in and see what exactly is the makeup of these products. So, real estate index, reality index, is a proxy for broader real estate development sector. So, it will consist of several of the real estate stocks. It will include companies that build and develop properties on land, residential apartments, commercial spaces, so on and so forth. REITs, however, is like a mutual fund of real estate, where um, a manager comes in and manages the property for you for a basically for a fee. It's a also a pool. REITs is a pool of high quality pre-leased properties. So they will take large spaces and then lease them out, and the rent that they lease rent that they're able to generate, some part of it goes as profit sharing to them, and the other part comes to you. In the reality index, most of the gains is coming from either property sales or land value appreciation. So some developer, let's say, has bought some land and is sitting on that land, and then 5 years later, he decides to develop that land. Then he's basically getting appreciation on the land and the development part that he will do. He will have some value addition there, and the stock which is likely to follow all these developments is going to give the returns to the stock buyer or the index or ETF buyer, so as to say. And all these big companies like DLF, Godrej Properties, Macrotech Developers, overall, all of them are in the business of redevelopment or developing new projects. REITs, on the other hand, will earn revenue from rentals and lease agreements and distribute those as your share as dividends to you. Embassy, Office Parks, Mindspace Business Park, Nexus Select Trust, etc., are some of the bigger REITs that are already in play. Now, in terms of volatility, real estate index, reality index has been very volatile. Significant highs and lows have been seen in the last 10 years. Index saw a major decline in 2008 post the financial crisis, and you very well know from 2011-12 till 1920 the real estate market was almost dead. But post COVID, there was a very strong rebound in the real estate markets. REITs, on the other hand, since their inception, it has been a new instrument, only 6 years since inception. Of course, they have shown much more stable performance with consistent dividends coming through, and they usually have a dividend distribution yield in the range of about 6 to 8% annually, and that provides a consistent source of income irrespective of market fluctuation. So real estate index is very dependent upon the actual real estate movements on the ground and equity market movements. REITs, on the other hand, are not so much dependent upon equity market movement, but of course some part of it, of the real estate moves, will impact REITs. The reality index since its inception, and here also the sort of shortcoming in the real estate index is Nifty real estate index is that it was extremely weighted towards some of the few large players like DLF, for instance. And since the inception in 2006, and over the last almost 19-20 years, the real estate index has not performed. So it did go very high at the 2008 peak, but then collapsed and has recovered. And just in the last leg of this, which is about last 4 years, is where the recovery has mostly come from. Now, if we see the all the four listed REITs that are there, so Embassy was listed since June 19. You can see this is uh, the performance um, since June 19, which is plus 7%. This is of course ex dividend. Um, Mindspace is plus 47%, Brookfield is plus 27%, and Nexus is plus 50%. Sorry, this is inclusive of dividends. So this is the returns on the REITs. The part which is very interesting is that since COVID, since 2020, real estate index has performed very well. So CNX real estate index is up 224%, and in the same time frame, the REITs have really not been able to catch up with these this kind of a returns. Obviously, because the capital gain on those properties not yet reflecting here, and the model is that the returns are going to be close to 6 to 8 to 9% kind of dividend yields. Now, if we adjust them for dividend, so previous chart was without dividends. If we adjust it for dividends, then also you can find that the best performing in the last 5 years has been Mindspace at 94% gain, versus Embassy, uh, Brookfield, and Nexus trailing behind. But nevertheless, I mean, for the purpose of which REITs was formed, I think they are serving the purpose. And real estate index, of course, being so volatile, may again go into some sort of a downtrend at some point of time. So all the listed REITs have given positive returns since inception. The dividends have enhanced performance, and yet, I mean, compared to real estate stocks, especially in the last 5 to 6 years, uh, they have lagged. So from 2007 till 2020, real estate index was in shambles. You can see nearly 2000 on the real estate index coming down to 180. So 90% of value was gone in that 13-year period. And you can see that primarily, for instance, biggies like DLF had reached 1200 rupees in their stock price in 2008 and eventually bottomed somewhere near, I think, 70 or 80 rupees. So huge kind of losses were seen on the real estate index. But post COVID real estate index has posted 449% return, and Nifty has done only 182% since then. So real estate as a industry has performed really well post COVID. Post COVID, you can also see that the CNX real estate index versus different REITs. Here you can see Nexus has done really well since its launch, which has been very recent, and others have trailed CNX real estate uh, far behind. So, what changed post COVID is the question, and favorable government policies like reduced stamp duties, tax benefits, RERA was introduced, which organized the real estate sector better, and the builder developers were also falling in line, following rules and norms, and the interest rates were falling, lowest repo rate to counter the slowdown post COVID. Then the COVID also changed, perception about housing as such, where people wanting to have larger homes, like husband and wife working in the same house and taking calls, they realize they need more space, and children also, taking their classes online. Everybody realized that larger spaces are needed for work at home and study from home. And then desire for home ownership also went up. The pandemic underscored the importance of having your own house, stable living, and the vulnerability of your own life. So if the sole breadwinner goes away, what happens to the family? That point, I think, really struck with a lot of folks, that I must make sure that my family is secure and safe. And buyers also want to prioritize properties with better amenities, focusing on their own wellness and well-being for their family. So this all resulted in consolidation of the market, and financially sound and reputable developers gained a large market share post-COVID. In Gurugram region, for instance, DLF did really well, and now other players have jumped into this space also. The investors also got a great fillip with running away prices. I think a lot of investors moved also into the real estate market, attracting a lot of institutional and foreign investments. And this also actually led to the rise of REITs. In 2019, when some of the REITs were launched, not many people were interested in REITs. But the rise of the real estate investment trust REITs, it provided a new avenue for investors, because not everybody has the capital to deploy in a actual real estate investment. And two is, some people may not want to do it through equity, because equity has its own uh, you know whims and fancies. Even if real estate is doing well and something happens in the equity market, even real estate stocks will fall. And that's why real estate REITs were listed post more and more REITs were listed post COVID. And the biggest sort of tailwind that REITs have got is that classification of REITs as equity uh, happened, and that basically brought benefits in terms of taxation, and that really has taken away some of the disadvantages that were there in the original format of REITs. And real estate index actually will be a bigger beneficiary as bigger and bigger REITs come to the market, because they will be taking up and soaking up the supply, and real estate developers actually will be putting that will be fulfilling that demand from the REITs. So that's where we are in terms of REITs versus real estate index versus real estate stocks. Uh, Let us know in the comments what you think about this space. You can also watch this other video, but I'll just give you 2 minutes of my perspective on what I think about real estate in general. I think while these two types of investments in real estate is fine, but it really does not, replace the desirability and the requirement, in my view, of having your own physical space. See, at the end of the day, whether it is a REIT, whether it's a real estate mutual fund, whether it's a real estate index ETF, these are all financial instruments. They are digital instruments. You have nothing in your hand, really speaking. What happens if your REIT company goes belly up? What happens if your mutual fund goes belly up? What happens if real estate index does not perform while real estate continues to do prosper? So the real aspect of the real estate is getting missed in all these instruments. I think a lot of influencers have beaten down real estate and other asset classes mercilessly in the last 2 3 decades, and it has it has resulted in a generation who does not want or does not feel like investing in real estate, because they feel that doing SIP in equity is a much better option. I think from decade to decade that view is going to change, and my sense is that as soon as you can, without disturbing your monthly saving or your day to day life, if you can invest in a real property, uh, even though it may be small, even though it may be in tier 2 town, one should do that, because that is a real gun to your head that you have to pay that EMI every month. It brings discipline in your life. It gets you a all kinds of taxation benefits. I'm not even talking about that. But in case that is not a possibility, then of course look at paper real estate exposure, which is obviously the next best to the real thing. So thank you so much for watching this video, and I'll see you in the next one. Don't forget to subscribe to the channel. Thanks. Bye.